3 years of AI optimism. Unwound in 4 trading days. The Nasdaq fell 4.6% this week, 5 straight losing sessions. Semiconductors dropped almost 8% in a single Monday. But here's what almost every recap is getting wrong. This wasn't a crash. The credit market didn't even flinch. This was a repricing, and the difference between those two words is the whole story. I'm Big Z. This is your weekly brief for the week of June 23rd. Let's read the tape. Start with the scoreboard. The S&P 500 finished down about 2%, at 7,354. The Nasdaq, down 4.6. The Dow? Actually green, up 0.6%. Read that spread again. The Dow beat the Nasdaq by more than 5 percentage points in 1 week. That does not happen in a healthy bull tape. That is defensive rotation, money fleeing long-duration tech for anything that pays you a dividend today. Small caps were noisier than usual, and there's a technical reason. The Russell's annual reconstitution rebuilt the index right after Friday's close, so treat its weekly number with a grain of salt this week. And the VIX? It spiked toward 23 on Monday's semiconductor scare, then settled back near 19 by Friday, fear that flared and faded, not fear that stuck. Under the surface, the rotation was textbook. Technology was the worst place to be. The semiconductor index cratered 7.9% on Monday alone, after a circuit breaker in South Korea forced the liquidation of leveraged chip positions, and $2.5 billion in foreign money bolted for the exits in a single session. Where did it go? Into utilities, staples, and real estate, the defensive trio all closed green. And into the banks, on a bet that the Fed's next move is a hike, not a cut. When utilities outrun chips by double digits in 5 days, the market is telling you exactly how much risk it wants to hold. Energy was the other big loser, and that's a story worth its own chapter. We'll get there. Now the chart nobody put in front of you. Despite a 4.6% Nasdaq drawdown, roughly 63% of S&P 500 stocks stayed above their 50-day moving average. Sit with that for a second. If this were a real market breakdown, breadth collapses, everything sells off together, the median stock gets crushed. It didn't happen. The damage was surgical, concentrated in a handful of mega-cap AI names, while the typical stock held its ground. That is the fingerprint of a positioning unwind, not a recession scare. Remember that number, 63%, because it's the thread that ties this entire week together. To the movers. Micron was the star of the week, shares ripped roughly 15% after a record quarter. $41.5 billion in revenue, a 16% beat, and data center sales now annualizing past $100 billion a year. Hold that thought, because it matters in a minute. On the other side of the ledger, the wreckage. Hertz collapsed 27%, used car values fell about $300 per vehicle per month, and the company poured gasoline on the fire with a dilutive stock and notes raise. FedEx actually beat on earnings and still dropped about 6% on the day, as trade policy whiplash squeezed its operating margin from 9.1% down to 8.4%. And Cerberus shed 16%, swept out with the AI tide. One genuine bright spot away from the carnage, Wendy's jumped 24% on a new chief financial officer hire. Even in a red week, somebody's catching a bid. So why did AI break? 3 things hit at the same moment. 1. Bank of America flipped hawkish, forecasting 3 Fed rate hikes this year, pure poison for long-duration growth stocks. 2. That Korean circuit breaker triggered forced selling across the entire chip complex. 3. Reports that OpenAI is pushing its IPO out to 2027, after SpaceX listed at $135, spiked to $225, then bled all the way back to $152 in 2 weeks. Suddenly the richest AI names looked fragile. And yet, Micron. A record quarter. Demand annualizing past $100 billion. The capital spending is real. What got repriced this week was valuation, not the underlying business. That's the call, and I'll stand behind it. If Micron just told you AI memory demand is the real deal, the full HBM supply chain teardown is next on this channel. Subscribe so you don't miss it. Now the 3 signals the mainstream recap skipped, and honestly, this is where the real read lives. Signal 1, uranium. Spot uranium sat dead flat at $85.75 a pound, even as AI-driven power demand was the single loudest story of the week. The small reactor stocks, Oklo, NuScale, Constellation, all trade on that data center power thesis. But the physical fuel price isn't confirming it. Utilities are still buying on long-term contracts, not the spot market. When the equity narrative runs this far ahead of the commodity, you watch for the gap to close, in one direction or the other. Signal 2, oil. West Texas crude fell to $73.61, a 3-month low, after the US and Iran framework reopened the Strait of Hormuz and the war premium simply evaporated. That quietly feeds the disinflation camp, even in a week when core inflation ran hot. A real cross-current for the Fed to chew on. Signal 3, and the most important one of the entire week, credit didn't blink. High-yield spreads held at just 2.6% through the whole tech rout, and the yield curve kept a normal, positive slope. When junk bond spreads stay this tight while the Nasdaq drops nearly 5%, you are not watching a crisis. You're watching positioning unwind. That one number is the reason I called this a repricing and not a crash. The IPO window told the very same story in miniature. While the AI listings wobbled, SpaceX fading, OpenAI delaying, a defense engine maker, DPC Holdings, priced above its range and popped 33% on its debut. Read the contrast. Capital fled richly valued AI and rushed straight into hard, cash-generating defense and industrials. The new issue market just ranked its priorities for you, in real time. That's not a coincidence, it's the same flight to substance you saw in the sector tape. Here's the data driving all of it. Core PCE, the Fed's favorite inflation gauge, accelerated to 3.4%, the hottest reading since October of 2023. First quarter GDP was revised up to 2.1%, so the economy is clearly not slowing. Jobless claims fell to 215,000, the labor market is still tight. The only soft spot was durable goods, down 4.5%, and that was almost entirely aircraft. Add it up, resilient growth, re-accelerating inflation. That is the higher for longer case in one breath, and it's exactly why Bank of America is suddenly talking about hikes instead of cuts. So what do you actually watch next week? A holiday-shortened one, with markets closed Friday the 3rd. 3 events. Tuesday, ISM manufacturing. If it holds above 54, the soft landing story gets a lot harder to tell. Also Tuesday, Fed Chair Warsh speaks in Portugal, his first words since that hot inflation print, and bond markets will hang on every one of them. And the big one, the June jobs report, pulled forward to Thursday because of the holiday. Here's your trigger map. A strong payrolls number cements the rate hike fear and likely extends the tech sell-off. A weak one hands the bulls their bounce. And the level that matters most, watch whether the S&P can hold 7,300. Lose it, and the next test is the 50-day line. Above it, the dip buyers stay in control. One last cross-market note before we go. The dollar stayed soft, near 101, even alongside that hawkish 3-hike call, which tells you the currency market isn't buying the Fed's tough talk just yet. That tension is worth tracking into July. The bottom line for the week, this was a valuation reset inside a still healthy market, not the start of something worse. And your single best tell that it stays that way is credit. As long as high-yield spreads stay calm, every dip is a rotation, not a rupture. The day they widen, we talk differently. That's your weekly brief. I'm Big Z, follow me, see you in the next deep dive.